Hello, this is Trever Acers, CEO of Objective Investment Banking. In my episode of Business Growth Architect, we're going to be talking about M&A, how to maximize that value. I'm going to share with you in this process a specific strategy that others aren't using about how to get the most from your business sale. Talk to you then.
Welcome to the Business Growth Architect Show. I am Beate Chelette. I am the host. I want to welcome you to our globally top 10% ranked podcast, where you will hear from industry experts about the strategies that are working right now to unlock hidden opportunities in any market so that you can grow your authority and scale your impact. And now let's get started with the show. Hello and welcome back. This is your host, Beate Chelette from the Business Growth Architect Show. Today, we're going to tackle a topic that I find fascinating, and I think you will be too, because we're talking about valuation, how to evaluate your business, exit strategies, and all the stuff that goes into preparing for sale of the company. And with me today to answer all these questions is Trever Acers from Objective Investment Banking. Trever, I'm very happy to have you on the show. I'm going to ask you a lot of questions today.
I love it. Thanks for having me. This is one of my favorite topics.
Excellent. So let's just get started right away. What is the biggest hurdle when it comes to an exit strategy for business owners?
Yeah, it's interesting. That question is incredibly relevant today, much more so than it was, call it 10 to 15 years ago, as M&A has become such a normalized business activity. It was relatively rare 15 years ago, but now it seems as business owners that so many of our friends and peers are talking about the fact that they've sold or are thinking about selling their business. It's a scenario that I paint for you is we're sitting at the cocktail party and we're hearing about all these amazing stories. So-and-so sold their company, so-and-so sold their company. All we hear is these great stories. The reality is a little bit different. The reality is that really merits this conversation today is that there's some surveys out there that say that greater than 75% of business owners, when surveyed 2 years after their transaction, respond that they feel like they failed in their transaction in at least one material way. What that means is sometimes that feedback is, boy, I didn't get enough money. The earnout didn't work out. But oddly enough, a lot of the time, it's not about money. Often it's something around, boy, I didn't like the acquirer, the way they treated my people. I didn't like what they did with my legacy. I didn't like how much time I had to commit to this new entity, these qualitative aspects as opposed to quantitative aspects. And the root cause that they're unhappy, they didn't know what they wanted when they went into the transaction. They didn't really understand their objectives.
I could agree with you more. When I sold my business, and I sold my business to Bill Gates, for all of you who have not heard that part of my story. And a friend of mine, a mentor, had just sold his company for $70 million, which was a much larger transaction than mine was by far margin. But what he did say to me was really critical in setting my expectations. He did tell me, they're going to do stuff with this that you don't like. They're going to take what you have for one and one reason only, is because they think that what you have fits somewhere in their thing to make their thing better. Sometimes they buy you just so you go away and you're not a competitor anymore. And then when you are, and they're going to be very, very nice to you until they own the company. And then everything changes, because then they want to extract the most out of you. They want to extract the most out of your people. They want to get rid of your people as quickly as possible. I think that's a great segue for us to really talk about if you're thinking about selling your business. So let's start at the beginning. When is a good time to start thinking about selling my business?
Yeah, so we're seeing M&A occur in the life cycle of companies dramatically earlier than they typically were. We were talking to a company yesterday. They're a SaaS company. They're at $1.5 million in ARR. Historically, that would be way too early to sell a company. What we have seen now is that acquirers are very much interested in buying companies of that size that are a little bit earlier because, as you said, they fit or achieve that specific objective they're looking for. I think we need to, as entrepreneurs, actually be thinking about what must be true in order for us to sell this value engine that we built much earlier than we might think. The first thing that we need to be thinking about is what must be true. what must be true to merit me selling this? And there is a quantitative element to it. That quantitative is really dominated by after-tax cash in my pocket. Because as entrepreneurs, as business owners, that is ultimately how we measure the financial outcome, not top line, not all these beautiful numbers. How much is sitting in my bank account at the end of the day? There's typically two parts of that. The first part is after-tax cash at closing, right? It's if 70% of the deal is cash in my pocket at closing, I want to know what that means after tax. This is where that CPA and that wealth manager are so critical, telling me what the after-tax calc is, helping me understand the relevance. And then the total value, right? Be it earn out or equity, other pieces. What does the after-tax proceeds eventually look like for that at-risk consideration? So that's the first.
Also the holdback, because a lot of transactions have holdbacks because there are assumptions that are being made. And typical holdback is anywhere between 1 and 3 years. In my case, it was 3 years. And so that also changes what you can do with the money, because if the holdback is significant, anywhere like, I think it's like typical a fourth to a third of the transaction is to hold it back. So you also have to recognize what's going to happen when you get that, because you're going to be paying tax because you're now in a different tax bracket from the earlier transaction. So your tax rate is going to be higher. So other things have to be done on that.
Yeah, and it's that earn out or that holdback is contingent. So we really want to think about the after-tax cash at the close, because that's the most sure cash. That's the number that I make my planning decisions on. And then this cash that I might get over the next X number of years, our recommendation to business owners is we think about that as the cherry on top. That's a great, nice to have, but I don't make decisions on that number because I'm too concerned about the fact that there's a possibility that I might not achieve that.
Yes, these transaction agreements are written often in such a way that if there's a unforeseen market fluctuation that may not be even your fault, that could be part of the holdback, because you make assumptions at the point of sale based on current market conditions. But let's say, hypothetically speaking, were we in a prolonged recession and somebody would have said, well, we made this assumption because let's say it's a luxury good, and now the market goes in a prolonged recession, we know that luxury goods are probably going to suffer. So that discretionary spending is going away. They're going to go back to, they're going to go back from Versace to Coach, or from Coach.
So that highlights why that after-tax cash or closing number is sort of that golden number that we talk about. We really try to help clients make a decision. And the other reason why it's so critical to have this, what we call your number, right? Why it's so critical at this stage. And by the way, the number changes, right? In the first couple of years, we're going to be a certain size. I might say, I'd sell my cash engine for X dollars. But the importance of that number, and then all these qualitative other things that must be true, right? My people must be treated this way. My legacy must be taken care of this way. The reason that's so incredibly important is it gives us the most powerful negotiation tool we can possibly have, which is the ability to say no. No, thank you so much, right? For that flattering interest and that flattering offer, but that does not achieve my objectives. And thus, without emotion, without concern about being wrong, I can pass on that opportunity, continue to be focused on growth because I know it's the right thing for me.
So I want to dive into that a little bit, because when I did my transaction, let's also not forget I sold to Bill Gates' company, and there's a whole apparatus in place just to protect Bill Gates. Let's say in a regular transaction, what do I actually have influence over? Like, what can I ask for? Because will I know the truth of why they're acquiring my company? And I can think of 3, 4, 5, 6 reasons to acquire another company, right? You save yourself all the development costs, the research costs. You save yourself the building. You already know what you're getting. You don't have the overhead of the people. You know exactly what the product is. You see it before you buy it. You have no lag time. It goes much quicker. You can see ahead of time how this fits into your product offering and what it will do for you. There's so many reasons to buy a company. So what do I have as a business owner then really control over realistically? Because once the transaction is done, it's theirs. They can do whatever they want.
Right. Yeah, there's two elements here. One is what can we negotiate? The other one is what can we validate or diligence? The first piece in negotiation, obviously we can negotiate purchase price. we can negotiate transaction structure. Beyond that, the lawyers would give us a number of terms that we can negotiate in terms of indemnification, think about risk mitigation, what have you. But I think the other things that often are less spoken about that are critical, we can negotiate as business owners. What's our role going forward? What am I going to have influence or authority over? Who am I going to report to? What's the scope of my role? You may not know before the transaction completes what exactly that's going to be, but we can definitely negotiate what impact I'm going to have on this future organization. How long am I going to have to be here for? That's a big aspect. I really don't want to, as an entrepreneur, I want to maximize flexibility and optionality. I really don't want to be held to having to be somewhere for some period of time. So a time-based earn-out or holdback, something to that effect. The other thing I can do is I can impact how you're going to structure my organization. Are you going to do certain things that change what I'm doing as a company? These are negotiable points as we go through it. The things we can diligence are a little bit more to what you're speaking to. Why are you doing this transaction? I can start that legacy component. If my people are being treated a certain way, if my culture is really important to me, I can reverse diligence the buyer. They're going to ask me 1,000 questions, but I can ask them just as many questions, right? I can ask them questions like, so tell me, culture is really important. How do you see my culture merging into yours? My technology is I really want to see this amplified throughout our industry. Tell me a little bit about how my technology is going to play into your roadmap. I can't get them to guarantee any of these things, but before saying yes and committing this possibly most valuable thing I've ever built to this new owner, I can really make sure that we're on the right path, that they're saying the right things that tell me we're going to go in that direction.
Can we just go maybe through a quick hit list of the things that people should be asking for? So one obviously is getting clear on the money. How much, and my advice on that is very simple. If the money doesn't change your lifestyle or it doesn't have an immediate impact, don't bother. I mean, that's my advice. So for me, I needed to know that whatever that number was, that I could buy a house so nobody could ever put me out on the street, and I could pay for my daughter's college, and I had enough money that would conservatively invested be able to maintain my current lifestyle. That was the number. And I knew exactly what that number was. But aside from that number, so you said culture, what are some of these other factors?
Yeah. So that number, which by the way, that wealth manager is just so incredibly helpful of helping figure out the relevance of. But those other aspects are people. If you talk to people who are frustrated with their transaction, it's very commonly, how am I going to treat my people? And it's because they went into this transaction without asking that question. So the question is, how are my people going to merge? I know that the acquirer might not have perfect insights of what it's going to look like exactly, but they should be able to give me some comfort in that they value what my people have done today. They value their roles, their talent, their capabilities, and that this is an opportunity for them to have a larger and larger stage in which to perform. That's what we want to ask. We want to ask around our technology. How's our technology going to be integrated into the roadmap? Tell me more about that. And again, while I can't get a guarantee, the more detailed an acquirer can go into, the greater fact that the probability that they've thought through this. And so those are critical questions. What's my role going to be? So we can start hearing about how they're going to value me and my time. It doesn't mean that I'm going to commit to stay there forever. I just want to know that there's an option, that this might be a great place for me to continue to go. So really understand those questions that we ask, the things that we reverse diligence, really depend on what our objectives are. If I don't care about my time and I'm exiting and I expect to be gone in 2 years, I might not care too much about what my role is. If I'm getting that life-changing money and I'm just going to exit out, I might not care. But if I do care, or if I care about my people, or if I care about my legacy, and that's incredibly important, I need to be asking those questions. And it's amazing to see how many sellers are scared. They don't think it's appropriate to ask these questions. They're concerned about what it perceives. And I think it really shows them that there is a emotionally intelligent, intellectual person on the other side who's asking all the right questions.
Excellent. And we will be right back after this quick message, and we'll talk about how to value your company. Are you looking for the hidden opportunities for you in this market? Or are you simply wanting to figure out what is your unique differentiation factor that makes clients want to work with you and not your competitors? If this resonates, I want to invite you to go to uncoverysession.com and schedule your 15-minute complimentary uncovery session with one of our business growth advisors that will take you through what your number one business growth blocker is, what you can do to remove it, and what your very best next step should be. And now let's get back to the show. Beate here with Trever, talking all things acquisition and getting your company ready for sale. So you said earlier that you see in your line of work in M&A that companies often get much sooner ready for acquisition than companies that are valued or that have $1 million in revenue oftentimes already on the market. And so there's a significant change. So for somebody who's listening and says, well, but how do I even know what kind of number I could get? Are there some examples of valuations you can give us or take us through that will help our listeners to understand how to arrive at a number?
Yeah, there are a couple ways to go about this. One of the easiest ways is valuations tend to be industry specific. So the valuation methodology applied to a software company is typically very different than a business services. So the first thing I want to understand is, how is my industry valued? And then what are the multiples, the range of valuation for my type of company at my size? Best way to, one of the common ways to do about that is Googling whatever my industry is, M&A report. Somebody out there has written out in the world, has written something in the last year to 2 years that has to do with my industry and sort of what the average valuations are. Typically, that's a multiple of earnings, of EBITDA. And we see that range and maybe call it, let's say, 5 to 7 times for a company my size in my industry. Other times in software companies, you're seeing it as a multiple of ARR, annualized recurring revenue. For every industry, there is a valuation range, and that's certainly influenced by size. The larger the company, the higher valuation is applied to that. The other resource out there is there are professional firms. Happens to have one, but there are professional valuation practices. And these professionals, this is what they do on a daily basis. Those can start at very high level valuations, and they can get incredibly detailed, really being thoughtful of not only about what's the valuation today, but what are the value levers that can be changed to increase that valuation. So there's some great resources out there. One of the most interesting things, though, I think that business owners should be thinking about when they think about valuation is not to fall into the default. So our world, acquirers and people out there, when they're looking at our businesses, they tend to use these default multiples of earnings.
Typically, yes.
Yeah. And it's the biggest mistake. So what we say as business owners is, boy, you're interested in my business. Let me tell you about my revenue and earnings. Let me show you my financials. You should give me a value that you think you want to buy it for. And the opportunity that we're missing is exactly what you hit on. That's not why they're buying us. They're not buying us for our revenue and earnings. Historically, they're buying us based on how much money they can make in the next 3 to 5 years by owning us. And so it's amazing how often these sale processes sort of skip this step. So our big recommendation in one of the methodologies we commonly use is to focus on something we call post-acquisition economics. So while I share with you as the acquirer my financials and I tell you about my organization, how my business runs today, instead of asking for an offer at that point in time, I stop there and I transition to, let's talk about Monday morning. On Monday morning, and we're part of your organization, how is that going to work? And what I really want to do is start identifying the different synergies that the combination of these businesses is going to create. And so I want to characterize those synergies, synergy A, B, and C, and then I want to quantify them. Boy, if we were part of you, you'd sell your stuff to my customers. This is how much revenue, gross profit, incremental profit contribution will be created. And by the way, you're trading at 10 times earnings. So this synergy, this is how much shareholder value it creates. So instead of buying me as a multiple of EBITDA, what I'm saying is, boy, if you bought me today, I'm going to create X millions of dollars of shareholder value. If I can create that, And if I give you enough insights such that your confidence level in achieving that goes significantly higher, your willingness to pay, logical willingness to pay, should go up as well. And when we talk about value, maximizing value, that methodology is the number one way that business owners can drive valuations outside of sort of the default norms.
That's interesting. I mean, when I sold the business, I did not know that, but I did sit down and I calculated for them what their return on investment was, and it was 3 years. I literally gave them the calculation, and I predicted that the reason they were buying my business wasn't going to be producing as much money as the one that they didn't, the piece of the business they didn't want, but that was ultimately going to be having a higher longevity and making more money, which it did. And I was right. And not just that, but I also trained every salesperson in the world. I created all the collateral material because it was important to me, and my objective for the photographers that gave me these images and my team, of course, that I was going to hand over something that was plug and play for them, that they really understood what that brand was. And for me, that completely worked. Now, listening to what you are saying, me not knowing this back then because I didn't listen to a podcast with you telling me this. So I intuitively or instinctively used one of these strategies to drive up my valuation, because I got a great valuation on gross sales and I didn't own a thing. I had the first right of refusal to license certain materials. I mean, the deal, if you really think about it, was kind of nuts, but good for me. So,
Yeah, and it's
so
a
you,
collaborative approach, right? It's a
it is,
collaborative
yeah.
approach. What we're told is we should be negotiating. And what we're saying is negotiation is great, but let's collaboratively work with this potential owner to really understand the value you're getting and have a very strong level of confidence. And it comes back to some logical concepts of, for example, you'll pay more for a 8 in 10 chance of winning $100 than you will in a 2 in 10 chance. But most situations, the acquirer is guessing at their ability to achieve these synergies until the price is set, and then they're doing their due diligence. And our methodology suggests that this due diligence around, can I achieve these synergies and are they valuable, should be moved prior to that negotiation, prior to that setting of the purchase price. It should be this collaborative process.
Let's talk about the mindset I need to be in as a business owner. So talk to me about someone that goes into now this negotiation. Is there a particular, what does this person, what do they have to have? Because I see this all the time. I know plenty of people that sold their business and then they fall in love with the option of selling, and then the buyer drags them on and on and on, and it's done for one reason only, is to make you want the deal more than they do, to drive the price down. So talk to me about my mindset while I'm going through a transaction or getting ready for a transaction. What do I need to know?
Yeah, so we have to be prepared to say no at any time. Again, that's that most powerful negotiation tool. And if, for example, in that scenario you're painting, we sign a LOI, an initial offer with the buyer, and then we're going to do due diligence and the terms change. If we don't have a strong sense of what must be true in order for this to make sense, we tend to just take whatever deal we get. And that's not the mentality we want. We want this mentality of I determined before I even started the conversations what must be true, what those objectives that must be met are, and I keep true to that. So if any point in time during this transaction, I find out that the price changed and it's not achieving my objectives, the structure changed and it doesn't meet my risk profile, I found out they're not going to treat my people well, or my legacy is going to be mistaken, I need to be able to be aware of what I said must be true so I can go back and say no. And often, if we think about this from a partnership, true partners trying to make something occur, I can look at that acquirer and say, boy, I'm loving where we're going. You just changed this. This doesn't work for me. If I'm an honest partner, we either need to change that, get it back to where it's going to work, or we should just be good to each other and walk our separate ways. And the more respectful we are of ourselves as business owners and our own objectives, and then being open as a good partner and sharing that with that counterparty, that's when we start making really functional decisions. So whatever we do, 2 years from now, sell or not sell, 2 years from the date, we can look back at that mirror in 2 a.m. and say, you know what? That was a really good decision.
Yeah. And I want to give an example so our listeners kind of can see that. So when I put myself out on the market, one company made me an offer and it was the most lowball offer ever. So they said, the worst offer I've ever heard. They said, we pay you $1 million, which was my revenue. And they said, and then you'll have to be an employee and run the division and grow it. And then we'll give you the $1 million. I'm like, that's the dumbest, most horrific deal I have ever heard about. I mean, why would I do that? I was already making, that was already my revenue. So I said no to that. And then I negotiated something completely different. I think you also have to rely on yourself as when your instincts are kicking in and your warning bells go off and you go like, I think there's an ulterior motive. Any other things that you think, and then I wanted to spend a minute or two on the current trend of every M&A person who's never sold or bought a business in their life, reaching out to business owners, asking them if they want to sell their business. What's going on in the M&A market right now? Is it like the Wild West?
So because M&A has become such a normalized business activity, we have, north of 250 or 2,500 private equity firms in the United States calling on us as business owners on a daily basis. I mean, I'm sure everyone's listening has gotten this email, letter, phone call of, boy, I looked at your business and I really like it. And it's they don't even know about our business. But we're getting these calls from both the people, the generalists who are private equity firms that are interested in buying us. And we're also getting it from potentially strategic partners, companies we've known for 15 years who we gratefully respect, like a Microsoft. You're saying, boy, we've been a technology partner for 10 years. And suddenly we get that call from them that says something like, hey, I know we've been great partners, but I'd love to acquire your business. And so I think that big question is business owners is, I'm getting hit on a lot to sell my company. What do I do? And we were just talking to a very large private equity firm about helping them educate their portfolio companies on how to do this. Because what their issue is they don't want the CEO to miss out on an opportunity to sell the company earlier than planned for some great number. On the other hand, the distraction of going through a sale process that doesn't end up in a result is incredibly expensive. And that's the thing that one of the biggest concerns that is really starting to emerge here, and the education that we need to have as business owners is when I go through a sale process and I give people all my information.
Oh my God.
I spend the next 3 to 6 months in these dialogues and it doesn't come to a great outcome. The classic being I get a call, be it Microsoft or someone, and they ask me 1,000 questions and I'm talking back and forth. And 6 months from now, I've taken 20% of my mind, of my focus and time and put it into this conversation and it doesn't go anywhere. And then I look at my revenue and say, boy, I intended to have 30% growth this year. And I only ended up with 15% growth because I was so focused on this conversation. And then I look at that growth and I start to value it in terms of enterprise value. So I apply the multiple to the EBITDA from that. And I go, wow, that wasn't a cheap conversation. In fact, that conversation cost me millions of dollars of enterprise value because I got duped into having this conversation without being able to figure out, did it actually merit me taking that much time? And it's not the attorneys, it's not the advisor's cost. It's the biggest cost is that management focus or waiting for growth.
Yeah, I think so too. And I have seen this, that companies have engaged in these conversations for the purpose of having you take your eyes off the ball.
Yeah, there's certainly, sometimes they call them fishing expeditions. There's certainly some fear out there that buyers are either trying to get your intellectual property, they're trying to figure out what you're doing, they're trying to distract you. The nice thing is that the vast majority of potential acquirers are not doing it for illicit reasons. They're doing it because they're genuinely interested. The problem is that genuine interest can still cost you months of focus.
I like to hear that. That's a really good message to say that from what you are seeing, and maybe this has to do with that it has become a much more acceptable way to buy companies, that novelty. I do believe that as there's more transactions and it happens more often and some people are doing multiple exits, that the recognition of this being a business building or business growth exercise for some of these companies has become acceptable, and they don't want to waste their time either. So I really, really like this message. So what I'm hearing, and I just want to recap this, what I'm taking away from our conversation, Trever, is that you suggest to really look at this as a partnership opportunity and to ask for things that you'd normally ask for in a relationship. Are you taking care of my people? Are you taking care of my stuff? Where you want somebody to come in and do the things that are valuable to you. While we understand that once it's sold, people tend to do, business climates often change, but that we do have some sort of control over it. But a lot of buyers out there are very serious. And if you have a professional partner like a company like yours on their side, a lot of these things can be mitigated. For anyone who's listened to this and says, I must speak to Trever, talk about if he's the right person to help me get my company on the market, where do we send them, Trever?
If you look at Objective Capital Partners or Objective Investment Bank, that's come into our website. Here's some stories about other entrepreneurs that have gone through this process. Read some of the articles. We have a number of industry practices, so read about companies just like yours, what's going on trend-wise within M&A. Our goal is to help entrepreneurs make really good decisions. So we've got some good resources there.
Okay, sounds wonderful. Well, thank you so much. It's been an absolute pleasure on the show. You are a wealth of information. Thank you so much for your time today.
Thanks so much. Really enjoyed this.
And that's it for us today. So thank you so much for listening or watching the show. And until we see each other again next time. And goodbye. Thank you for listening to or watching the show. We are so excited that you're here and we are very grateful for you. Now it's our turn to ask you for help. Please do share this episode with one other person that needs to hear what we were talking about today. If there's any question you have about business, please do reach out to us and let us know. And don't forget to schedule your complimentary Uncovery session at uncoverysession.com, where one of our business growth advisors will help you to figure out what your number one business growth blocker is in only 15 minutes. And that's it for us today. Until next time.